Submit all. Here we go. Good morning, Adam. Morning, Chris. Morning, Paul. Morning, Natalia. Morning, Peter. Morning, the other Peter. Thanks for joining. Really appreciate everybody joining. If you've just joined, if you could mute, please, that would be great. And cut out any background noise as we usually do on these occasions. Really appreciate everybody joining. Hang on, there's Ian. Morning, Ian. Thanks for joining. Good to see you. Morning, Aaron. Thanks for joining. Let's just wait another minute, possibly, and then see who else is joining the party. If you could mute Ian, that would be great. Thanks very much.
Say good morning to me.
And good morning, Michael.
Thank you.
There we are. And good morning, Richard. There we go. Okay. Excellent. Quite a full agenda today. So welcome everybody to this week's coffee morning, Pension Playpen coffee morning. Obviously, last week we were in pre-budget mode, and this week we are in post-budget mode. And one of our esteemed gurus, Con Keating, has been busy looking at the impact of the budget, and I'm sure there's going to be lots and lots of opinions and views about the post-match analysis of the budget, and whether our esteemed Chancellor is hanging on by her fingernails. So obviously we've got a very strong board. Obviously we've got Con Keating, thanks to Con, we've got Tom McPhail, we've got Fiona O'Hara, and we've got Professor Mike Bromwich. So thanks all for joining the round table. It's a bit of a free-for-all like last week, so obviously we'll open the chat room up, and if you want to raise a hand and ask a question, please do. And the session is also being recorded, so Chris, Mike, Tom, Fiona, everybody's happy being recorded. We are recorded, and we'll get the video up later on today. So without any further ado, probably Con, if I pass to you first, this is your slideshow. I know there's a fairly long list to go through, but let's start with your thoughts initially.
Yeah, let's go through quickly.
Go for your thoughts, and just to stir the pot, Con, can you comment on the OBR's 4 billion surplus, which seems to have been ignored by the Chancellor?
Well, the Chancellor, not to put too fine a point on it, told Porkies about how large the deficit was going to be. Relative to her 9.9 billion of headroom, she actually had only consumed about 6 billion. And that's after the 0.3% decline in productivity growth in the OBR's forecasts. But let's we'll see some of that in later on in these slides. Let's just what did this budget do? The answer is this budget was mildly redistributive for smaller households, and that's what this diagram shows. The bottom decile of earners get about 7% increase in their household income. Okay, that's disposable income. That number goes down to around 2% in the fifth decile, and of course the top decile finish up losing around 1% of their income. Now these are percentages of your income. So the bottom decile, who might be on 10 grand of household income, actually they're 7% better off. That's 70 quid better off. Whereas if the top decile is £120,000 and they're 2% worse off, they're down a couple of grand. Okay, that's the important thing to realize about this. This is how people are relative to their decile, or relative to their existing income. So mildly redistributive, frankly, a waste of time. Let's go to the next slide, please, Fiona. Right. These are the basically these are the Red Book figures for the effects of the budget. Yeah, and it's the OBR's forecasts as modified by the Treasury that you're looking at there. So, GDP growth basically doing nothing between 2025 and 2030, according to this, with a small dip in 2026. What I particularly want to draw attention to is the fixed investment area of that slide. Now, this slide is busy, so we'll pull up another one in a moment showing the investment approaches. But if you look at what the line that I find impossible to believe in is the consumer price index that everything's based on. It's currently 3.5% or so. They have it falling to 2.5% next year and to 2% and staying there over the following period. Quite frankly, I don't think that number is credible. The employment numbers suggest that we don't really get any material increase in unemployment over and above what we currently have. I also think that is unlikely because I still see the hospitality sector losing lots and lots of jobs. And then the contentious number, which has been much talked about by all and sundry, which is the productivity output or productivity in terms of output per hour. 0.7, 0.8, 0.91, they hope. In other words, they hope for increasing productivity gains over the period to 2030. Frankly, I don't believe that. I don't see anything in what's being done here that is likely to increase productivity. Now, in that context, let's talk a bit about the levels of investment implicit in this budget. Can you go to the next slide? We can see this much more clearly. So these are figures which are percentages of GDP. So figure 1% of GDP is what's 1% of GDP? About 1% of GDP is about GDP 2.6 trillion. 1% of that is 26 trillion. So when it's 26 billion, no, 206, no, 26. Anyway,
It's a big number.
yes, it's quite a big number, but they have business investment in this, basically going nowhere over the life, but increasing dramatically in the period 28, 29, 30, which, given that's when all of the taxes kick in, I find incredible. General government investment is, again, it's in 2025, 2.5 billion. That's largely all done. We know that stuff. But they claim that we're going to have material increases in both 2026 and 2027. That 13.2% of general government investment is actually around 300 billion or so. So where they finance that from, I don't know. I think that's because the tax receipts that could possibly pay for that don't kick in until 28 and 29 and 30. And then they have private dwelling investment, which of course is largely away from the government and councils. So this is private sector investment. They have housing development and housing investment booming in 27 and 28. And there is absolutely no way this is, so that's around 400 billion of investment over that 2-year period. There is no way our construction industry is capable of building houses or budgets at that sort of rate. There just aren't enough brickies, plumbers, or anything else. So yeah, a problem, I think, there. But net, there's not a lot of incentive to get business investing in its own business, or whatever. And yeah, they seem to think that from a really low level in 2026, this is going to increase steadily over the period of the forecast. I don't believe it. So anyway, this is actually where you can think about what was going on with Reeves and the OBR. The left-hand side shows household disposable income per person. And you've got the old forecast, the 2025 forecast, and the new forecast, the pre-measures forecast, which is the dotted line. In other words, household declared disposable income was seen by the OBR as declining. The effect of the budget itself, again, as forecast by the OBR, is slightly more positive in the early stages and more negative in the longer stages, which I think I agree with, because you're going to see the impact of the child cap and rail fare fixing and so on in the early stages, and everything will come home to roost in the form of higher inflation and higher taxes in late on in the period. The right-hand thing, simply the right-hand side of that, simply shows you the components of the growth rate of the economy, and it shows you the forecast as in March and the most recent November forecast. So let's just go to the next slide, please. This is nothing to do with the budget. This is all about the US economy and what happens if we do get an AI slowdown there. And I think the answer is something pretty horrible, because it's AI expenditures, capital expenditures, which are actually responsible for the majority of the growth that we see in the US. If we see a slowdown, and I suspect a slowdown is likely in that capital expenditure, then the US will come down dramatically. And as a comment I made on one of Henry's blogs this morning suggests, that will take an awful lot of the other AI entities, including the UK, which has spent a few billion and has programs in hand based on AI. They will also go in the waste paper basket. That's a take on what the budget does and doesn't say, and what I think is the biggest single problem going forward, which is US and AI. That's, I think, the end of my slides, isn't it?
Yep,
Yeah.
looks like it. Brilliant. Okay, Con, that's very interesting. Thank you very much. Obviously, if anybody has any questions, please raise a hand. Tom, let's come to you first. What are your sort of post-budget thoughts? I mean, obviously we've got a list of areas to discuss, but I mean, obviously Con's done a lot of good work there. But what do you think, Tom? You're on.
Yeah, thanks, Steve. That was really interesting, Con. Thank you. I want to come back to a couple of things you said there and a couple of thoughts of my own. I mean, just on the point about the Chancellor telling lies, yes, she's a politician. It's in the job description. I found it kind of interesting that my friends on the right and political commentators on the right are clutching their pearls and saying, well, obviously she's got to resign. She lied. She misled everybody. It's terrible. And I
Well,
think
the
back
in,
to
the
to
interesting
Boris.
thing about this, though, Tom,
Yes.
is normally when politicians are lying, they are telling you things are better than they are. What's unusual about this is she's telling you that we needed 26 billion or whatever a number was, more than we actually did. Yeah, painting a black picture
Yeah.
It's a
No.
good,
rather
it's a
than
good lie.
painting a
It's a good
positive.
lie.
I detect the hand of Torsten Bell being a bit too clever by half in this. I suspect he may have had a hand in. Let's brief everybody that it's really bad, and then we can do a bit of bait and switch, and won't that be clever? But look, when Boris got ambushed with the cake, right, and everybody on the left clutched their pearls and said, well, he should resign over this, and it was clearly there was a lot of hypocrisy going on in Downing Street. But this is the nature of British politics. So I think you've got to cut through that to what's really, really of substance. I've got a piece in the Times today talking about the complexity in the budget, and that's one of the things that really annoys me. And related to that, there was almost nothing in the budget that was actually about growth, right? This was this was a very political budget. It kept the backbenchers happy. For now, it's kept the markets happy, but I think that's a slow burn car crash happening there. But pretty much everything she's done has made life more complicated. We already had a very progressive income tax system, certainly, and tax system more generally, and it's become even more so. And that equation of feathers plucking to hissing is getting increasingly strained, and I think that's increasingly problematic. Just thinking about slides, I just do not believe that unemployment rate projection. Everything I'm seeing and hearing tells me the unemployment rate is going to go up. I was at a drinks do last night with a lot of local businessmen, some of them retired. The combination of she lied over the business rates, right? The business rates are going up, not down. So the business rates, coupled with the NI increase, coupled with the minimum wage, a lot of hospitality and tourism around here where I live, unemployment is going to go up. And then looking at slides, looking at the business investment numbers, I can't see businesses investing, and I'm actually deeply worried by the slide suggesting that a lot of the investment over the next 2 years is coming from central government. Central government does not invest money well. Businesses invest money well, and business investment is going flat at best and slightly downwards. And I agree with Con's observation about the private dwelling investment in 27-28. I can't see that happening either. So, Treasury and OBR forecasts are always a bit a wing and a prayer and a Hail Mary and all the rest of it. This seems more so than many I've seen. I just don't believe a lot of the numbers I'm seeing there. But look, we'll see. There wasn't nearly enough about energy. The energy prices in this country are destroying our economy. Belatedly, they're starting to talk about nuclear power, but our industrial energy prices are the highest in the world. There's something four times the price the Americans are paying, and we wonder why our economy is imploding. By any measure you choose to apply, it makes no sense, and I find it immensely frustrating that there was virtually nothing about that in the budget. So the bond markets kind of shrugged over the end of last week. I think over the next year or so, a lot of this is going to come home to roost. And on those tax rises landing in and around election year, I can't see those sticking either. So I mean, personally, I thought it was an appalling budget. I think it was just a really missed opportunity to do a lot of the important heavy lifting about fiscal consolidation and reducing welfare. And she's done all the wrong things. But I'm politically biased as well.
All right,
I
Tom.
like the rail fare. I like the rail fare freeze.
You win.
But that's
Look,
Look,
self-interest.
hang on. Look, I got a check this morning from Avanti for £120 because of a glitch in my booking a couple of weeks ago. The whole rail system is absolutely bonkers. Every time my train's late, they throw money at me. I'd rather they just made the bloody trains run on time.
There you go.
You should try getting refunds from London Northwestern. It's virtually impossible. Believe me, I've tried.
Wow. Okay, Con.
Anyway,
Right. So, Michael Bromwich, let's come to you, and then we'll come to Fiona to talk about salary sacrifice. But Michael, your overview and your thoughts on Con's comments. You're on mute, Michael. So if you want to unmute, there we go. Any? Oh. There you go. Can we hear? There we are.
Do I want to join all the grumpy old people?
Well, let's get the grumpy people out of the way first, and then we'll talk to Fiona, who's always happy. Now, go on, Michael. Go on. You tell us what
No.
you think, because you're on the table. You tell us.
Well, I mean, it's first of all, there's a lot of fuss about lying and things. That can be left to the politicians to sort out as best they can, I guess. But I mean, I think most of us knew there was some money hanging about there. But let me be clear, as I understand it anyway, the money that we want is really the, if you like, the backup money in case things go wrong. And at the moment, that's still quite low compared with what previous people have had. So that's a worry, I think. I suppose the other thing is, I'm used to budgets which sort of laid down some sort of structure for the future. You know, we're going to do this, we're going to do that, we're going to do something else. Doesn't seem to be there this time. And already, for example, the Prime Minister's going on about 18 to 22-year-olds can't be ill. That is, they don't get any universal credit for illness. That's going to make a lot of difference to what's going on. And I think so many things are. I mean, if you look at, my wife's a housing economist, if you look at housing, there is absolutely no way they can make their 1.5 million. There's no way at all. It's really quite difficult. I mean, all you can really do, I think, is say, to a degree they sort of saved the day so far, and now it depends on what they do, which is hardly an exciting thing. The other thing, everybody keeps going on about fuel prices and so on, and they're right. That is a matter for us. We can choose the fuel prices. I mean, marginal cost pricing may work where you have big dips and so on in your use of electricity and all the rest of it. But it doesn't necessarily work when so much of your electricity is now being powered by wind and so on. They need to look at that. And why don't they look at that? When all the politicians have agreed that it's a ridiculous thing that's going on with electricity and power, but that's all they agree on. They don't agree on trying to do anything about it. I think that's part of the problem. I think the other problem is that the general view very much with the Prime Minister and so on is, don't worry, we've got it nicely sorted now and we'll sort everything out as we go along. I just don't believe any of that. So I'm don't want to be a grumpy old man, because I've seen what he does to other people. But I still have to say there is a fair amount of grump wandering about my mind.
There is. Let's go to Fiona and talk about a specific issue. Thanks for that, Michael, your opinion there. Let's go to the specific issue of salary exchange, because Fiona, you're a sort of SME specialist and you're at the coalface, so to speak. And actually, we might get the Dangos in later on, because I'm interested on the impact of, you know, the sort of lower paid and the people that use salary exchange. And what impact it could have on the lower pay. But anyway, yeah, go on, Fiona, you go first. You're at the coalface.
Just before salary exchange, and I get what everyone's saying about, you know, essentially about the budget and the numbers, but moving sort of away from the numbers themselves, like talking about it being a political budget. Is it something that needs to be considered in terms of political leanings in this country? And if it's a budget that appeals to the working person and perhaps the lower paid people who are part of, maybe forming a part of a certain party that we don't want our country to be leaning towards, or maybe you do, but is that partly motivating some of the budget? I don't know. it shouldn't be. I get that, but is that sort of part of where that's coming from? Some of the people we do deal with are the people who are going to benefit from that extra £70 a month, and it's a budget that it does appeal to them emotionally. It looks as though this was a budget for the working people, for people who aren't necessarily quite as economically savvy. But that's just my opinion on it. In terms of salary sacrifice at the other end of the scale, the people I work with, it has had quite an impact. Obviously, in terms of pension saving, I think it makes it a harder job for, I guess, maybe people on the IFA side of it. Obviously, pension investing is still reasonably tax efficient. But I guess it makes it harder. It makes scheme pays, I guess, more of a topic on everyone's mind. So I think people are still digesting it in the workplace. I think making it 2029 has softened it, because HR and finance teams are quite notorious for putting off having those conversations until they need to. So I think those people who are on the ball have realised that it is going to be really quite significant down to that 2K limit, and also it's probably going to have increased charges for businesses in terms of payroll, because payroll are going to have to amend all of their systems as well. So I suspect that's going to have a knock-on effect to businesses. Whilst it's going to be fairly small, it will still have an impact. I think it's good news that it was pension schemes only. I appreciate electric vehicles are going to have a pay per mile, but even if you do 10,000 miles, that's sort of £300 a year, which is obviously very different to fuel costs. So whilst it might dissuade some people, I don't think it will put people off electric car schemes, particularly as you're still going to be able to salary sacrifice. And also things like cash plans and PMI in that space, that you can still add your dependents and salary sacrifice those benefits. I think that was a positive for me. I think removing salary sacrifice across the board would have had a bigger impact. But I think it is going to increase probably salary sacrifice car schemes.
Yeah. Okay. I appreciate that. Ferret Information Systems, otherwise known as Dangos now. I don't know why it's changed, but I don't know. Why did you change? Anyway, it doesn't matter. What do you think about the sort of lower paid and sort of middle England? Do you think it's a budget for the people or not? Oh, you're on mute. Are you on mute? No, can't hear you. That's weird.
It probably helps if I turn the microphone on.
Oh, there we go. We can hear you now. Hurrah.
Yeah.
Sorry.
Always grasping technology here.
There we go.
Yeah, I mean, I think Dangos, by the way, is just this particular team's account. It's a project we deliver for Welsh Government that's training people in financial awareness. And I think financial awareness is something which means a little bit different, perhaps, to the kind of people that we deal with and most of the people on this call. I think it's probably fair to guess that a progressive budget is likely to be viewed less favourably by people on this call, as it's likely to hit them, where a regressive budget would kind of do the reverse. And the reverse is true for the people that I talk to and that we deal with. I mean, Con's comment about 7% isn't worth anything to anybody. £700 a year to somebody on £10,000 a year is actually worth an awful lot, and considerably more than probably somebody losing £2,000 out of £200,000. I think the budget has the best kind of ambitions in mind. But any budget, the ideal budget is always one that gives me more and takes less from me, I suppose. And everybody's got that personal view. And in this case, it's trying to do a little bit of redistribution. But more importantly, I think it's trying to put things in place that are more likely to have a long-term effect rather than a short-term kind of profit effect. It's looking more at the balance sheet, I suppose. And I'm no financial kind of competent, let alone expert, so I'll probably misuse all the kind of terms. But the bit that I think is infuriating me, and I don't want to imply that Con or even Tom are in this state, is the misinterpretation and the deliberate misinterpretation of the budget and its effects. I just posted a kind of analysis of an article that was in the Telegraph on Saturday about the budget effect on benefits and working people, which headlined itself as being people in work £18,000 a year worse off than people on benefits. I actually crunched the numbers in detail, and the reverse is true. It's £16,000 a year better off for somebody who's in work on the terms that they posted, rather than £18,000 a year worse off. And I think that's kind of the unfortunate example of what's going on in a lot of the commentary that's being made about the budget, is that the commentary is being designed to meet the ambitions of the commentator rather than being an objective and rigorous study of the effects.
Yeah. Okay. Appreciate that. Tom, you got your hand up. Let's talk to you, Tom, and then we might come to Henry, because Henry, I think, has joined now, but he may have an opinion as well. And then we'll come back to some pensions. But Tom, go on. You got your hand up.
Yeah, no, on that last point, I think it's extremely valid. I think more so now than has ever been the case, there's just a huge amount of confirmation bias going on. And whatever your ideological starting position, you're just looking for data to confirm that. And that seems to be true to me, to be a characteristic of a lot of people's political analysis about budgets or whatever. So I mean, I kind of agree with you about that. I think, which is sort of implicit in the point you were making, that, you know, the Telegraph just set out to find a set of numbers that made it look like working people were being punished for the benefit of the welfare dependents, and guess what? That's what they found. So there's a bit of that going on. I mean, maybe this is an unwelcome sort of change of direction, but I just thought it was worth highlighting something else that struck me in the last few days, which is around the incentives to save for retirement. And one of the characteristics of the pension system has been that those who pay higher rates of income tax in work could, in many cases, look forward to paying basic rate tax in retirement. And that was one of the sort of almost unspoken but well understood benefits of the system. That looks like that is being quite significantly eroded now. And if you fast forward the current trends, in another 10 or 20 years' time, an awful lot more people are going to be paying higher rate tax in retirement. An awful lot more people are going to be paying tax in retirement. And that's an uncommented on, as far as I can see, aspect of the fiscal drag that's going on at the moment, and the threshold freezes. Then you throw into the mix what we've already briefly talked about with the cap on salary sacrifice. Throw into the mix the inheritance tax imposition on pension funds. And broadly, in principle, I'm not averse to the idea of throwing pension funds into the same pot as everything else for inheritance tax purposes. But I've seen this constant trend since 2010 and the coalition government, and they kept chipping away. By the way, being able to put £250,000 of income into your pension fund every year was bonkers too. So, you know, the pendulum swung too far one way, and then it's been swinging back the other way. But all these decisions, whether it's reducing the annual allowance or introducing the money purchase annual allowance or the tapered annual allowance or capping off the lifetime allowance, all these decisions are made in isolation. The cumulative effect we've seen over the last 15 years, and we're definitely seeing it now, is a progressive erosion of these incentives to save. And none of these decisions are made in a coherent, considered way. They're all taken in isolation. And one thing that I really wish the Pensions Commission had been tasked with, and it very obviously hasn't been, would be to take a step back and say, okay, what's the trade-off here? As a state, you know, what are we doing to incentivize people to save for retirement? How are we going about that? What are the incentives and rewards we're putting in place to encourage people to defer consumption? And I just want to call out that fiscal drag has consequences for retirement saving as well. So I'll just stop there. Thank you.
Okay, Tom, thanks very much. Appreciate that. Henry, do you want to say a few words? And then we're going to talk about DB surpluses, but we'll because we're sort of pensions group really. If you talk about DB surplus, but Henry, what do you think?
DC surpluses or DB surpluses? I think
DB.
Okay, yeah, that's fine. I think that this question of growth was something that I was yabbering on about at the end of last week's session, and saying I do hope that this will be a budget for growth. It isn't, as Michael says, and it is disappointing that there wasn't a clear message coming out of where this growth is coming from. I hope that we will have a pension system which does what it did when I was young and promotes growth in this country through investments. And I think that that can happen when we move from what we have at the moment, which is a DC system of saving, to a collective system of pensions. Different things. The investment strategy is completely different when the risk is being shared rather than simply being placed on individuals individually. And I'm pretty sure that what's going on in the minds of our pensions minister, who appears to be acting as a sort of pensions chancellor of the exchequer as well, is that he will find a way from this pensions bill and from the CDC stuff which he's pushing through as fast as he can to get us back to where we were in the 80s and 90s, when we did have a best endeavours type strategy for investment. So I'm not quite sure whether anybody had the guts to say that on the day. I'm pretty sure well, obviously nobody did because nobody said it, but I think that that's what's going on in his head. And as far as we're concerned, I think we're pretty important people to not just the pensions minister, but to the government, because there's more money in our pension systems than anywhere else. And he doesn't need a lot more money to go into our pension system to achieve what he wants from pensions, which is basically the refloating, if you like, of Great Britain. So that's me.
Bye, Henry.
Second rant in 2 weeks.
Thank you, Henry, for that rant. We've got a few actuaries on the call, Adam Baxter and Chris Bumford, Adrian Swales. Apologies if I haven't mentioned your name, but let's move on to DB surplus. Maybe William will come in as well at some point, but Adam, Chris, do you want to go? Or William, you got your hand up. Let's start with you. Go on, William. What do you want to say? You're on mute, William. You're on mute.
I thought it was quite an interesting budget, and a couple of little tweaks that were made to changing how discretion could be exercised. I think it's much easier. That's a very big positive. And really the 97s, the pre-97 people, if you're going to, in the future, you're going to have indexation up to 2.5%. I think that's a really big point, because what it does do is all the thing I'm endlessly bang on about in TAS 300. You have to do the calculation between run-on and bulk transfer. If you do those sums again now, you're going to say, oh, my downside's not much in falling. My upside is getting bigger. Therefore, if we run on, that looks attractive. So it should mean the consequence should be more schemes run on. And if you take the interesting broader point for the economy, if more schemes run on, all it needs now is for the government just to edge people to saying, well, if you're running on, we'll help you or incentivize you to actually put more money into productive UK investments. And if you look at the total amount we're talking about here, we've got 1 trillion in DB, we've got 350 billion in, let's say, life insurers. That's 1.5 trillion. You don't need more than, let's say, an extra shift, let's say, into UK productive and maybe sustaining gilts, let's say 10% more over time into the UK economy. That's a lot of dosh. And if you're running on, let's remember that the pensionable payroll in the UK of DB people is 50 billion. Okay, right. If you say that we're going to have these discretionary payments made easier, and they just, let's say you get 0.5% a year going that way, that's a 10% uplift. That's 5 billion into the economy. It makes some of these numbers, like making mansion house taxes, look kind of small beer. There's a lot of money, big numbers, and I think the government is so close to a big win, which it may not even, well, I'm sure Torsten's so clever enough, he will have spotted. It's not that far away. And I'm right with Henry. I think there's some clever people pushing things that you're going to end up with more recycling of money into DB, to CDC, a big government initiative there. I think they're not that far away from getting on a winner here, but they just need to follow through. Anyway, that was my take on that. I thought there was more positive in it than might be apparent.
Hi, William. Thank you very much.
Can I come in response to William? It's all fine, well and good to say, let's invest in the private sector, but in the absence of growth, the returns from private sector investment are likely to be lackluster at best. So if we don't have an overarching framework that is encouraging growth, particularly in the private sector, which is where we're going to be invested overwhelmingly in your scenario, William, that looks like a self-defeating strategy.
No, I agree entirely. It needs to be seen more holistically. I just feel that you're going to get, if you switch the balance from more sellers that have been for the last 20 years to a few more buyers, you're going to get more interesting projects, more buoyancy into the UK market. It doesn't make it all work. It just means you've got some tools to play with in terms of your investment strategy. I agree. The growth stuff, well, where is it then? What you're going to be investing in, but it does mean there'll be more money available. And people, I just think if the government gets a few of these things in the right order, and just then the pension sector and in many private investment, obviously worked in that's for most of my career. I think people will spot as a change, a shift, and an opportunity. And I think you'll get people coming to the market, and maybe the government can just sit back and let it happen.
Okay, William, thank you. Peter, you got your hand raised, then we'll come to Chris. Go on, Peter.
Yes, thank you. I just wanted to pick up on the last 2 points from William and also Con. Background, I tend to think, sitting as a trustee of a pension scheme with a very large surplus, which is being funneled back into the company by means of a reduced employer's contribution in DB, which in turn is lowering the employer's employment costs going forward for the next few years and making it more viable for the employer to expand its activities or at least retain its activities. That is a positive thing, and I actually think the government is subtly trying to achieve that. So like the salary sacrifice arrangements are to encourage employers to consider what their employee contributions are, and on which they continue to get national insurance and tax relief. Well, sorry, the employees get national insurance, the employer gets tax relief only. On that scenario, although obviously the situation is if you pay less and give a larger defined benefit pension, the employer gets a benefit from the national insurance effect. So I actually think that they are actually trying to encourage people to continue DB accrual and possibly reopen DB accrual rather than put the money in the hands of schemes and CDC falling in between. But the DB, obviously, the employers have a vested interest in the long-term investment of the funds and that sort of thing, and will encourage the growth type investments. So that was my take on it.
All right, Peter. Thank you very much. Thank you. Chris, what do you want to say?
Well, thanks all. And yeah, echo the thoughts about the sort of money flowing to CDC being a really good thing coming forward. There was one point in the budget about the pre-97 indexation on PPF, which feels like quite a small point for a number of our schemes, given they're not worried about the PPF, and is obviously a way of using up the surplus in the PPF, and will be great for those members. I just thought I'd flag that we have some schemes that closed before 97 or shortly after with no increases, and we're now into a sort of really interesting situation where the lifeboat would be offering considerably better benefits for those members than the actual pension schemes, and the effect on the kind of ongoing employers that's a sort of massive change in the liability that they sort of signed up to, and we haven't worked it out yet. We've just got a couple of these schemes where we're in the situation that the benefits that the employer's funding and will be looking to buy out would potentially be lower than the benefits the members would get if they fell into the PPF. Now it's quite a situation that they didn't expect to be in.
So what you're saying is, even with the haircut, the members' benefit over a longer term would actually be better in the PPF than in the current scheme.
And for a lot of these schemes, the vast majority of the membership are pensioners, so we're not really talking about a haircut particularly. We're just we're just
of course,
finding that it's a difference between an increasing pension and a non-increasing pension.
Yeah.
And it's just it's obviously to be done with the right intentions, and it's great for those members, but in the PPF, but it gives potentially a little bit of an issue for the trustees and employers that are in a similar situation.
Yeah. Okay.
What is follow up on that, because I think it's really important that in tomorrow's debate there are two amendments, 22 and 23, which aim to put that right. One is by the Conservatives, 23, but the one which I really like is 22, which is coming from the people who are actually impacted on this, the association, and we should really follow how much support they get for their position, which is that they do get some kind of extension of this pre-97 restitution. And incidentally, that restitution in the PPF is not backdated. Although we thought originally it isn't. So it's only going forward, which isn't much good for the dead.
Can I just come in? The PPF's estimate, or the Treasury's estimate of the cost of pre-97's 2.5% going forward, not applying to that which is backwards. The estimate they have in everything is around 1.25 billion, and then a further 60 to 70 million a year going forward, declining obviously as you get far out, simply because there are no pre-97s left alive beyond some point. But in terms of the PPF surplus, it's trivial. It's less than 10%. If on the other hand you were to apply it to retrospectively, you probably multiply that by something like 10. So don't expect any attempt to rectify meaningful amounts backwards, because those schemes which haven't been giving anything pre-97, if you were to make it compulsory for them to offer pre-97 retrospectively, you'd basically break most of those schemes.
I would not like to see any scheme taking surplus for the benefit of the employer until they had satisfied at least the minimum condition that they offer the same pre-97 increases as the PPF will do.
I'd agree with that.
Okay, thank you, Henry. Adam, you had your hand raised. Do you want to comment on that, Adam? And also, isn't there a reticence? Hi, Adam. Isn't there a reticence of employers adopting generous surplus distribution and then suddenly finding out from the actuary a few years later that actually it was a little bit bit too much too quickly, and actually the schemes fall into deficit again. Could that happen, Adam? And yeah.
Well, yeah, I mean, I was going to make 1 point, and now it's 2.
Two
but
points.
Firstly, I think to pick up your 2 points there, Steve. I think the first one is, as I understand, the PPF paying increases on pre-97 pension is only where the scheme would have paid increases. So I don't think the PPF is enhancing anyone's benefits, but is protecting a degree of inflation protection that would have been there under the scheme. The other thing is about the surplus distribution to members. I think that's actually a really good thing. Much like the benefits of CDC, a lot of important decisions have not been made because they're in the shape of guarantees. And if you're distributing surplus to members, the current process will enhance your increases, which is a promise that you're making for a long time and has cost implications, and conditions change and suddenly do you regret that? Or conditions don't change and you regret not doing it in the past. So I think being able to make one-off payments or change the form of these distributions is going to give trustees a lot more control and options around how they might structure surplus distributions. And I've got a few schemes who are looking at wind up and have very large surpluses. And even if it's just making a neat distribution before then winding up at a later point, I think that's a really useful change and option.
Okay, Adam, brilliant, thank you. Michael, you got your
Hi,
hand
Adam.
raised.
Yeah. I'm an accountant. You know, the dental scheme. And I'm very worried about the surpluses. These surpluses are not something you can go to the market with. They are made up constructions of guess what's going to happen over the whole damn time, and they can change very easily. And what the accountants talk about is realised gains, that is where you got the money, and unrealised gains where you haven't got the money. And I'm very concerned that I can see people, we had it before, they had a holiday in the 70s because of the surpluses, and the 80s were awful because of the 70s. I think we've got the pension people need to look much more at these surpluses and what they really are able to do with them. But it worries me immensely that you have unrealised numbers and people are going to spend that money even though it's not there. It needs to be looked at, I think, much more seriously than it has been. What we don't want to do is to, in due course, find you've got a crisis of some sort and the government intervenes, because the government tends to get these things even more wrong than most of us. Anyway, that's
All right, Michael. So what you're saying is that schemes or trustees shouldn't be spending chips they may or may not have. Is that what you're basically saying?
That's exactly right.
Right. Okay. Chris, what do you think? And maybe Adam or Chris will answer that question. But Chris, what do you think?
Yes, I just wanted to support Michael's point there. Essentially, surpluses are unrealised profits. They're ephemeral. We know the volatility of liabilities, particularly over the last 4 or 5, decade or more, and the position can change quite dramatically. So I would be happier, and I think I've made this point many a time, if the DB industry moved away from gilt yield valuation of liabilities to long-term expected rate of inflation, so something that's more stable, and therefore you have a margin that you can have more confidence in going forward. So I very much want to make that point, that it's you're potentially, if instead of the market stabilizing on Rachel Reeves' on-off income tax rises, and gilt yields had spiked, 30 years over 6%, 10 years over 5%, and suddenly we have a bit of a crisis, then suddenly, those numbers can move pretty dramatically.
Okay, so Adam or Chris, as actuaries, do these surpluses actually exist? That's the question. To be or not to be?
I mean, I think these are all good points, and the distribution of surplus is not going to be right for every scheme. I think it's going to depend on circumstances. And in my mind, if you've got a mature scheme, mostly pensioners, invested in such a way that whatever most conditions in the market mean that you could still go to an insurer and buy out. So you've got a big gilt portfolio, you've got some inflation hedging in there, then your surplus is protected to an extent. And I think it's those situations where this is most beneficial, because if you're 140, 150% funded and you can buy out and you still got that surplus, you want to give half of it to the members, this gives you a chance to consider those options, I guess. So no, a surplus isn't always a real thing. It can come and go, especially when you've got active members or an equity investment strategy. But yes, it might be well protected in other situations where you're well hedged without necessary leverage or anything like 2022. Yeah.
Okay. Chris, you got a view?
Yeah, and the other thing is, let's be honest, we've spent the last 20 years throwing money at the employees from 20, 30 years ago, 20, 30, 40 years ago, and all the sort of new earners of today haven't benefited. They're getting auto enrollment minimum, we're throwing. So we talk about surplus and that sort of stuff. The benefits that were earned many years ago were far more valuable than the benefits that are being earned now, and we've got an opportunity now to enhance the benefits potentially for people going forward, whether that be through CDC or whether that be through any other kind of medium. Surplus, it may, as Adam mentioned, the calculation can be done in a number of ways, but what's not in doubt is that a disproportionate amount of money has been thrown at the benefits that were accrued 20, 30 years ago. And if there's an opportunity for that to be spread across and maybe enhance the benefits for members going forward, then that will have to be a good thing, and help to change that pension gap, the gender pension gap. All those things will benefit from some of that surplus being used for members today.
All right, Chris, your hand is raised again, but any comment, Chris?
Yes, I mean, I'm all for reducing contributions or enhancing benefits. What I'm more concerned about is the extraction process that is in the legislation. In other words, the opportunity potentially to extract money. I fully accept, if you're doing a valuation, albeit I would prefer valuations to be done, as I say, on a more stable metric than long-term gilt yields, then you can you can change the levels of, particularly if the employers are making the contributions, they accept that contributions can go up and down.
Yeah, appreciate that. Okay, we're nearly closing to the end. I've got two questions. First one's to Tom McPhail. Are you happy you took your tax-free cash, Tom? And have you bought a Lamborghini?
I haven't bought a Lamborghini, and yes, I'm extremely happy I took my tax-free cash, because I did the numbers, and I'll still end up ahead within a couple of years. And he didn't cap and Rachel didn't cap the ISA allowance, so it's all good.
It'll pile into the ISAs. There you go. Okay, so
Steve, can I just interrupt you? I'm going to have to go for a very boring reason. I have a flat tire, and someone is here to fix it. So
I hope you get your puncture sorted.
Thank you so much, everyone.
Yeah, cheers, Fiona. Last question to the panel. Will Rachel Reeves be Chancellor in 12 months' time? Tom, you go first.
50-50.
Con?
No, can't give you better than that.
Con, yes or no? There you go.
No.
Okay, Michael, yes or no? Let's say no.
Microphone, Michael.
Microphone, Michael. Henry, yes or no?
Yes,
Ooh,
with
okay.
Torsten pulling the strings.
Okay, Michael, yes or no?
I'm an academic, so I don't get involved
hear-
in practical things.
No, we can hear you. We can hear you. Will the Chancellor be there in 12 months' time?
But as I say, I don't get involved in practical things like
No,
that.
me neither. But I was just interested to see what the panel thought. So there you go. But
But I mean,
there we are.
one thing that needs to be looked at again is the OBR claim that their predictions are 59% likely to happen. I don't understand that, and I think somebody needs to help me there. Thank you.
Okay, Michael, thank you very much. Okay, we're out of time. I'd like to thank the roundtable panel, including Con, Fiona, Tom, and Michael and Henry. Thanks very much. Thanks for your questions. We will see whether the Chancellor's around in 12 months' time. But yeah, very interesting thoughts and comments and questions. So I hope you enjoyed today's session. We'll put the video up very, very shortly. We will pay for Peace in the East, Henry. Pay for Peace in the East, I think. It could be happening before Christmas. It could happen.
It could.
In the East. So there we go.
We could get the video today.
And we could get the video today. Yeah, that's
equally likely.
Equally likely. Thank you very much. Yeah. But thanks everyone for today's to joining today's session. Really hope you enjoyed it, and we'll hopefully see you on next week's session, which is yet to be confirmed, but I'm sure it'll be as exciting. So there we go. Enjoy your rest of the day, and thanks for joining. Lots of claps. Cheers, Tom. Cheers, Con. Thanks a lot. Cheers.